Good morning, everyone.
Good morning.
I know you all are dragging from having watched the exciting Super Bowl late into the evening. That was really not meant to be a true statement. But anyway, let's call to order. I will call to order this meeting of the Mayor Commission work session. Today is February 9th, 2026, and the time is 10:02 p.m. And we will dive right into the agenda. Ms. Johnson, do you want to tee it up, or we're going to go straight to our CFO? Ms. Souffrant.
Good morning, Mayor, Commissioners. Bridget Souffrant, Chief Financial Officer. I'm here today with John Rauerbach, our Treasury Manager, and Avril Smith, our Assistant CFO. We also are here with John Grady, our Managing Director from PTMA Financial Solutions, formerly Public Trust. John is our primary relationship manager and is here to present the 4th annual investment report. Per the city's charter, we have an investment committee consisting of internal personnel who meet quarterly to oversee the management of a portion of the city's assets. The assets that are currently under management with PTMA are funds that are not needed at the present time based on cash flow projections, nor are they spoken for with a specific intent such as bond dollars. The annual investment report today will cover a brief economic outlook from our friend at PTMA, and then John will discuss the investment strategies covering our liquid portfolio, core portfolio, and restricted cash in his presentation. John?
Thank you, Ms. Souffrant. Mayor, Commissioners, Ms. Johnson, good morning. Another year has passed and another Super Bowl has passed. So I don't know if there are any Patriot or Seahawks fans in the crowd, but I hope you enjoyed the game. It's good to be back with you this morning. Thank you so much for the opportunity. And so I thought what we'll do is our normal format. We'll just spend a few minutes on an economic update, and then we'll jump right into your investments, which are doing very well. A few major economic themes to consider, of course. First of all, we had the longest government shutdown in history in the fall, and that did a few things, of course. It impacted federal worker pay, but it also delayed not only the release of economic data, but also the calculation of that data. And that then impacts the market somewhat. Certainly, markets are driven many times by the release of these various economic data points. So that played a role in the release of some of this, including GDP, which is one of the reasons why we still only see third quarter GDP. Fourth quarter, the initial release will occur here later this month as a result of that delay. Another economic theme to consider is, of course, the Federal Reserve and the fact that the FOMC will have a new Fed governor by May. And the current leader in that role is Kevin Warsh, and Kevin actually is a previous Fed governor. He actually served from 2006 to 2011, so a really pivotal time in our economy when the global financial crisis happened. He was instrumental, along with some other governors, of establishing programs to really help us get out of that severe economic downturn. So that's something that will likely play into how the Fed operates this year, in addition to the chair, other Fed governors. And then we'll talk here in a moment, the deteriorating labor market, yet still seeing and experiencing pretty decent economic growth. And so that we'll talk about economic growth here just for a moment on GDP. So third quarter GDP, we can see on the far right, came in at 4.4%. So pretty healthy economic growth for the quarter. In fact, it was the strongest growth in 2 years, going back to September of 2023. A couple of highlights, of course, one is that it was led by really strong consumer demand and spending for that quarter. We also saw very strong corporate profits. So even though we saw tariffs starting to take effect last year, in fact, when we were here at our meeting a year ago, it was the initial conversation of tariffs, and certainly saw a bit of a roller coaster of tariff discussions through 2025. Certain trade agreements have taken place. Others, in fact, with China, of course, still remains unresolved, and that's our largest trading partner. But some trade agreements have been put in place. So tariffs were a big talk, of course, and that has continued to keep prices elevated. We saw CPI move higher and then drift a little lower towards the end of 25. But with regard to the overall economy, again, we ended, at least through the third quarter, we'll see what happens with this fourth quarter release, with stronger consumer spending. So if we look those last three bars on the right, the blue component represents personal consumption or how we spend, and each quarter we we increased our spending, contributing to larger economic growth. So good news there. I don't have a slide on it, but I can't help but mention that we still have very high consumer debt as well as federal debt. So debt still is a big part of our conversation when it comes to the longer term thought of the economy. So GDP, I think much better than what many maybe expected in the beginning of 2025. Thinking about the economy and jobs, as I mentioned, the labor markets certainly have deteriorated. In fact, this morning on the way down from Orlando, I was reading a couple more articles in the Wall Street Journal just about it's becoming more difficult for folks to find jobs. And if we think about jobs through 2025, in that fourth quarter in particular, we actually had negative job growth in the fourth quarter. That was the first time in several years, separating out, of course, the COVID pandemic period. And then for the year, 584,000 jobs were created in 2025. There were 2 million jobs created in 2024, so a significant drop-off in new jobs created. And then a big part of that fourth quarter, though, we had negative net jobs in October of 173,000 job losses. That had everything to do with the federal government jobs that rolled off. If you recall, a number of those jobs were cut earlier in the year, but the employees were being paid through September 30th. So that was a big part of that October job figure. So as we're going now into 2026, the markets are being described, or the labor markets are being described as a low hire, low fire. So we're not seeing a lot of layoffs, although you may have read of Amazon, Target. There have been some larger companies doing some layoffs in the tens of thousands, but not massive in scale. So again, not a lot of firings at this point, but not a lot of hirings either. So the labor market will likely be a challenge here in 2026 as companies are still trying to navigate this economy. And then back to the tariff discussions, how big of an impact will tariffs have and how that impacts their hiring. Unemployment has increased from the low 3.8%. It was actually as low as 3.5% a couple of years ago. But at 4.4% historically, that's pretty healthy, a healthy unemployment rate. So that hasn't necessarily had a negative impact on the markets, even though we've seen unemployment increase. The other side of that unemployment rate, though, is we still have somewhat of a low labor force participation rate. So what that's telling us is that of the working age population, the current level is around 62%. That number used to be as high as 67 or 68%. And every percent represents around 2.7 million workers. So there's 10 to 15 million workers out there that for one reason or another have not re-entered the labor force. So unemployment remains, again, historically at a decent level, less than 5%. But if you factored in those additional 10 million or so, that unemployment level would be much higher than what we're seeing. And so I think that's something that the markets are looking at as well. So economy growing, labor markets slowing. And then if we look at inflation, thankfully that's come down a bit at the end of 25. You likely read, in fact, November and December were both the same reading at 2.7 and 2.6% respectively for core and overall. That number was actually ticking up higher through the spring and summer months. Again, a lot of that due to tariffs, but we did see a bit of a downturn or lower inflation at the end of 2025. The good news is that inflation is coming down, but prices are still increasing. So always want to make sure we mention that. A couple of highlights of the most recent CPI reports. Shelter, which represents around 35% of the basket or the calculation, was around 3.2% annual increase in shelter prices. So that's whether you're buying a home and or renting. That's nationally. Of course, those numbers vary widely by region. So 3.2%. I mention that specifically because if we think about the last couple of meetings that we've had, shelter costs were up 6-7+% year over year. So they're still increasing, especially here in Palm Beach County. This was one of the hotter markets following the COVID pandemic, as we had a lot of migration inflow, housing costs really increased. That seems to have leveled off, and we're seeing that both here in Florida, here in Palm Beach County, as well as nationally. So CPI coming a bit lower. That's hopefully going to help the Fed with their decision making, whether they're raising that overnight rate or lowering that overnight rate, which leads to this particular slide. And I know there's a lot on here, but just as a refresher, when we look at the yellow box, when we see negative numbers there, that is the market pricing in a percentage chance of a rate cut. And so what we're seeing here, this is just as a couple of weeks ago, the market's currently pricing in 1 to 2 rate cuts through 2026. So if we go from the top, the January meeting, of course, passed, they did not cut the rate. And as we go through each of these Fed meetings, you see that negative 1.8 at the bottom. That's suggesting that, again, potentially as many as 2 rate cuts this year. The overnight rate, as you recall, a couple of years ago was 5.5%. It was the highest level in over 20 years. They cut that rate to 4.5% at the end of 24. Through 3 meetings, a 100 basis point rate cut. They followed that similar pattern here at the end of 25. They had 3 rate cuts of 75 basis points total. So we went from 5.5% to the current rate of 3.75%. And as a reminder, the overnight rate is important because it governs what overnight investments are paying. And so while that rate has come down, and we'll see in a moment, the overall investment program that you employ is very balanced, and you'll see that even though we saw rates come down by as much as 100 basis points, your interest rate actually came down a fraction of that, and interest earnings actually increased. And that had everything to do with your investment committee, Ms. Front, Ms. Averill, and Ms. Rollback, and Mr. Rollback, and our partnership of maintaining that balanced investment program to help mitigate the volatility in interest rates. If we look year over year through the end of 2025, the big news was really we saw a downward shift of around 70 basis points or so. Again, on the left-hand side, that was driven by the overnight rate cut of 75 basis points that we mentioned. And then as we go from left to right, looking at Treasury rates out to 5 years, those rates came down in similar fashion, really due to projected slower economic growth over the next couple of years, driven again primarily by the expectation of tariffs and reduced spending by the consumer. So fortunately, we didn't see a dramatic drop in rates, but we did see somewhat those rates come down about 0.75%. And just lastly, looking from the economic perspective, the last 2 years, what it looks like, a lot more volatility in 24 and into 23, which we're not showing here, but 24, you can see interest rates are moving by as much as 100 basis points from quarter to quarter. We've seen a downward trend as we move from left to right, and we see current rates settled in right around 3.5 to 3.75%. Overnight rate is at 3.75% as a reminder, but you see all these colored lines moving together, compressing. That's that flat shape of the yield curve that we're currently seeing. And so whether you're in 3 months or out to 5 years, the rate differential is very similar. So when we look at your investment program, the idea, though, is to help use a balanced approach with overnight money and then laddered investments between really 1 to 2 years out to 5 years. And we'll see that in a moment, how that can protect you and help protect the income opportunities for the portfolio over time. So those are a few comments from the overall economy. Again, decent economic growth. Labor market somewhat questionable. Inflation seems to be moving in a favorable direction as well. And we're seeing less volatility in the fixed income markets at the time. Let me pause. Mr. Front, any comments from you or Mayor or Commissioners? And otherwise, we'll move to the investment program.
Thank you for that presentation. We will get copies of these slides afterwards. Any thoughts on the impact of AI on jobs, and is some of the deterioration in the job market attributable to AI? And I'd love to hear your thoughts on that.
It's a great question, Mayor, and I don't have an answer, but I have some thoughts on and what I see and what we're reading. In fact, one of those articles I mentioned this morning was talking about AI. The tech sector has really been impacted by the number or lack of new jobs in that sector in particular, and some layoffs, because these tech companies are trying to figure out how they can use AI, probably more than some of the other sectors since they're so in tune to that. A lot of what I'm reading and seeing out there is a conversation seems to have shifted from millions of job losses due to AI to more of those who learn AI are going to be the winners, whatever career field you're in. And if you don't learn AI, you're going to be in the loser bracket, so to speak. So that's what I'm seeing. I'll just say personally how that is impacting me and my family. I have 2 teenagers. And so when I read these things and talk to my 15 and 17-year-old children, I mention how important AI is to learn, because it likely is going to impact every facet of our life as we continue to move forward. So I think it's the conversation shifted from massive layoffs or lost jobs, millions, to I'm certainly going to be job losses. AI can do these tasks that, whether you needed 10 people to do these tasks before, now you can maybe do it with 1 or 2 or 3. But more of, if you learn it, you're likely going to have a much more of an opportunity for success in that career field. It seems to be where that conversation is going.
Thank you.
Yes, sir.
Another follow-up to the tariff discussion. Have we realized all of the impact of tariffs, or are we still kind of assessing that? It's been over a year now, but I'm hearing mixed reviews.
And I'm seeing the same thing. And honestly, it's very difficult. And I think, and I've read where companies are suggesting the same thing. Our credit analysts, by the way, internally at our firm, when they're doing credit reviews of companies we invest in, the companies themselves seem to not even be aware or have a good understanding yet of the impact of these tariffs. A lot of times it could be a tweet or a conversation that moves these markets about whether a tariff's going to be 30%, or, if this event happens, so I'm going to increase your tariff, and then 2 days later the tariff's off the table. So I don't mean to be tongue-in-cheek about that, Mayor, but I think it's still so uncertain. And then with China being the largest trading partner and not knowing how that's going to pan out, I think that's why these companies are so hesitant to hire at the moment, for those that are not hiring, because they don't know the impact. And then when the tariffs take place, how much of the tariff can they shift to the consumer without impacting the consumer so much that they stop buying your product or service? Tariffs, I think, it's still a big question mark from our perspective.
But notwithstanding this relative uncertainty, the stock markets are just going through the roof.
I wish I understood that.
I'm not complaining, but
I'm with you, Mayor. Just to comment on that, just to see the volatility. I mean, just look last week. We saw the NASDAQ move, I think, 4 to 5%, and then Thursday and Friday, right back, and did see the Dow over 50,000. I wish I could understand that. But, when you look at the downturn earlier in the week from the NASDAQ in particular, it was driven by companies shifting right from the chip makers or to memory. And then for whatever reason, why did that change Thursday and Friday? I don't know that it changed, the perception of what's going on between memory capability and what's going on with the computer chips. But I'm not an equity expert by any means, but I'm with you. I don't understand why we're seeing so much volatility. But to your point, that does help the consumer. Historically, when our 401k statements look better, we tend to spend more. When our housing values are elevated, we tend to spend more because we feel good, even though that's not necessarily a liquid asset. I think those are certain things that are helping the consumer continue to spend, but I also believe that they may be contributing to consumers' willingness to take on more debt, because we feel like we can pay that debt if we have equity in home and in our 401ks and other areas, for sure.
Commissioner Warren.
Thank you, Mayor. I believe my questions are very similar to yours. When I look at the 10 to 15 million people that are not employed, I'm wondering if that's because people have now shifted more towards entrepreneurship. People are doing things more on their own versus going into the labor force, because I know that I've had vacancies that have been vacant for a lot longer than they have been historically. My vacancies now are 3 months and 2 months, which historically I've been able to fill very quickly.
Okay.
So I'm wondering if you have any thoughts on that, and then I'll ask my second question.
It's a great question. So the way that the job unemployment rate and jobs are calculated is it doesn't take into account these gig jobs that you're referring to. So entrepreneur, but it could be you're wanting to start your own business, but it also could be your Uber Eats or Uber driver or these other gig jobs. And the estimates are they are in the 20 to 40 million range of jobs that are not being included in here. So that could be a reason for that. I'm curious. I'm not sure with your vacancies, the other thing I was reading this morning, and I didn't mention earlier when it comes to jobs, is actually because the labor markets have shifted from the employee to the employer, that there are now newer companies that are they're called reverse recruiters. I had not heard of this, but now individuals are paying recruiters to help them find jobs by writing their resumes and cover letters and actually having them reach out to 50 companies as opposed to trying to do it on your own. So that was something I hadn't heard about, and I'd be curious if actually you've received resumes or anything like that from a reverse recruiter company. No. Okay.
I don't know. Is HR in here? None have come across my desk, but they would probably end up with our HR department.
Is that right? Okay.
Yeah. You had a follow-up, Commissioner?
Yes, I did. You spoke about the increase in consumer spending, and that's kind of alarming too, especially considering that it's tied to consumer debt. And this is along the tariff conversation. Is consumers, and I know that this is just a conversation, but is consumer spending elevated because prices are so high? Going to buy a case of soda now is $10 a case, where it used to be 2 for $10. So people are still spending. They're spending more, but they're receiving less, and the dollar is not going as far. So they're subsidizing that through use of credit.
I believe that's a big part of it. Yes. And if you look at different income levels, it's certainly impacting lower income levels by a greater degree than higher income levels. And I think that's where the bigger challenge is. That's where I'm always concerned about the level of debt. And so to your point, because prices are higher, you're spending more, maybe getting a lesser amount of whatever that product is. I agree with that. And I do see these articles where you read where folks are borrowing just to sometimes just for necessities to live, and that so does the music stop? Everything's great when the Dow's at 50,000 and people are doing, but then do you get to a point at month end where all of a sudden your credit card's at its limit? You still have a car payment, a rent payment, or a mortgage. I don't mean to go down this wormhole with this, but that's the part I fear. We don't talk about that. I don't think that's being talked about enough. And so I'm glad things are going well. I hope that we can manage through this. But the reality is the debt is every quarter they release that, it's at a new level. And I think consumers are being more challenged through these higher prices. And again, the prices aren't going down. They're just thankfully not going up as much as they were a few years ago, but they're still going up for sure. So I hope that was more of a conversation. And Mayor, when you'd asked me a question, I'd love to hear your thought, if you have any thoughts on the tariffs in particular, because I think
I think it's TBD. Yes. Because the tariffs are, I perceive, they're being used as kind of a negotiation tool. So I don't think that you can really predict where the landing spot is going to be, because it's kind of being used to extract concessions from other countries. And I think the market has kind of, I think initially when tariffs were announced, the market kind of freaked out. But I think the market has kind of said, okay, this is really kind of a negotiation, and I don't think we've really seen the impact on consumers yet. A lot of companies that are paying tariffs, I think, are kind of keeping their powder dry in terms of passing those on to consumers. But I think that is a ticking time bomb, quite frankly. I'd love to hear your thoughts on the national debt, which is spiraling, I think, out of control.
Yes, sir. That is one area where I can't explain why we can't reduce our spending. A big part of this deficit, of course, is because we went into COVID and increased our spending by trillions of dollars. COVID's, hasn't been on the table for a couple of years, and we're still spending the same amount of money. And now we've been running $2+ trillion deficits. I don't know how we maintain that. And then when you start to read into it, this isn't for necessarily today's conversation, but I encourage you to, when you see articles on the use of stable coins and cryptocurrency, I do think that that's going to play a bigger role in our economy going forward. And I think that the conversation has shifted from, especially from even the large banks that maybe a few years ago said, I'm paraphrasing, but don't invest in Bitcoin, for instance, it's not real. To now, a lot of these banks are heavily invested in that and into cryptocurrencies. You know, Trump signed in the Genius Act last July, which ties into the stable coin. The state of Florida, by the way, has a House bill in the legislature. I think it's a House Bill 1415 that would potentially establish stable coin here in the state of Florida. So we've gone from just cryptocurrencies to now this use of stable coin. Why am I talking about this? Because the stable coin now is tying it to U.S. Treasury debt and the dollar. And so how that all plays out, I think, is going to be a big factor in how this debt is managed going forward. But I am also a big believer that when we keep hitting these new higher levels of debt to GDP, it's unsustainable. You can't grow your way out of debt at some point. And that's, you know, we go back to the conversation we just had. If consumers stop spending and and the federal government's not collecting taxes, how's that debt getting paid? Even to interest. So that I think that's a big challenge as well, Mayor. Sure.
President Lambert.
Thank you so much. I appreciate the conversation talking about volatility and, you know, which funds we are choosing to use for investment. Can you talk a little bit about the positioning of our portfolio as it relates to this volatility and making sure we're secure?
Absolutely. May I jump into our investment presentation, because that will directly answer your question, Commissioner?
Yeah. Commissioner Blues, did you have any questions or comments on this section? Okay, no, we can dive right in.
I did have one other comment just before you jump to that, if that's okay, Mayor. Just, I appreciate what you're saying about AI.
Yes.
I was recently at a presentation, I believe it was the presentation I was at with the president of Vanderbilt University, where he was talking about, someone asked the same question, Mayor, about losing jobs to AI, and he said, you likely will not lose your job to AI, but you will lose your job to somebody who knows AI better than you if you don't get on that bandwagon.
I'm glad you shared that, because that's exactly what I'm hearing, and so if the president of Vanderbilt saying that, I feel pretty comfortable in that comment. Thank you. Okay, sorry. Thank you. And thank you for the questions and the dialogue. I appreciate that. Let's jump into your investment portfolio. Thank you, Ms. Frank. So just a couple of quick update, or just reminders for you. So we, of course, work closely with Ms. Souffrant, Ms. Smith, and Mr. Rawlback, as well as the investment committee. And we have conversations on each investment decision as part of the overall investment program. We meet quarterly with the investment committee and have a formal discussion. We have an economic update, and then we also have a conversation about your overall investment portfolio. We discuss cash flows. In addition to the quarterly investment reviews, we have a monthly report that we work with Mr. Rawlback and we prepare that shows you a full picture of your overall investment program, which helps you all make those decisions each month as well. So it's really about transparency, reporting, and communication are really key to having an efficient investment program. From PTMA or public trust standpoint, our goal is to provide not just the commentary that you hear from me, your portfolio manager, and the relationship team, but also to make sure that we're contributing firm-wide resources, operations, accounting, as well as credit research, and then portfolio management, as I mentioned. So let's look at a review. So just as a reminder, I won't read all these bullet points, but it's here for you to have. Your investment program is governed by Florida State Statute 218-415, and that's the statute that governs all public entity investment funds here in the state of Florida. You also have your investment policy, which further restricts those permitted investments based on the City of West Palm Beach's investment parameters and risk tolerances. And if you'll recall, you actually approved your most recent policy in June of last year. So you have a very updated investment policy. It's very well written. We work closely with the team to update that. And that you are compliant with both the state statute as well as your investment policy statement. Your investment program is structured to meet your three primary investment goals. That's safety of that investment. It's making sure that you have the liquidity you need both in the short term as well as the near term, and then utilizing laddered investments for longer term uses and reserves. And so we do that with that laddered approach to your in fixed income securities. And as I mentioned, reporting on this, communicating this with your team, and then meeting with you annually to provide the results of that investment program. As Mr. Front mentioned, Your investment program is really broken into two separate strategies. Your first is your liquidity investment portfolio. So this investment portfolio provides daily liquidity from local government investment pools, which are similar to money market fund strategies. You utilize three, you now use four. They're all AAA rated investment fund programs. You can pull these funds out on a daily basis as needed. And then you also utilize a couple of bank deposits. The bank deposits that you utilize are with qualified public depositories, and that's in line with Statute 280 here in the state of Florida. And that means that your deposits are collateralized, and that is a level of protection for those deposits that you have. If we look at your investment program as of the end of your fiscal year 2025, you can see your liquidity balance just under 327 million. And the book yield on those investments was 4.32%. If you think about the overnight rate at 4.32%, and back at the fall, overnight rates were about 3.75%, so still maintaining above those market rates, utilizing these investment programs in LGIPs and banks. And also just mentioning, because you're using more than one, you're diversified within these programs, which we find a lot of value in diversification as well. This represents around 37% of your overall assets. Your liquidity portfolio is complemented by your investment portfolio that PTMA manages on your behalf. And you can see in this investment portfolio, if we go from fiscal year 2024 to fiscal year 2025 on the top, and you look at the difference in market value, all of the values, in fact. So what happened during the year, as we did in the prior year, looking at your cash flow needs, looking at your liquidity balances, taking into account the direction of overnight rates and seeing that they were starting to drift lower, and working with the team, and we started to ladder out additional investments. So you can see the growth in the portfolio from September of 24 to September of 25. That had everything to do with identifying some assets that you weren't going to need for liquidity that we could ladder out there for you, capture some investment rates. And in fact, during the period, that fiscal year, we reinvested and invested some new money with an average rate of around 4.06%, so just over 4%. And just keep in mind, the current rate's at 3.5%. So you have that added value by laddering in and locking in some of those rates, really out between 3 to 4 years for the most part. But just looking at the shape of the yield curve and looking at the existing ladder of securities. So if we look at the bottom right-hand side, that chart shows you the percentages of investments from 0 to 3 months out to that 4 to 5 year area. And just as a reminder, 5 years is the max maturity. So we look at this when we identify available funds. We work closely with your team and make investment recommendations, or the team asks us to look at certain maturities to help you have more of a laddered approach. You can see you've got about a little less than 25% in that 1 to 2 year area, but your portfolio overall is well laddered and well diversified, primarily focused on U.S. Treasuries. Working with the committee, that's been the decision to focus there, and it's actually worked well because you're not really getting a lot of extra yield going outside of Treasuries right now. And so having that safety first approach and utilizing Treasuries has been helpful. This portfolio earned $37.5 million over the last fiscal year. It was actually an increase of that. I'm sorry, when I mentioned that, that is your overall investment program of $37.5 million. Your long-term portfolio earned right around $20 million. So if we look at it in aggregate, you can see individual portfolio characteristics, that table in the center of the chart. We start with your local government investment pools, 2 bank deposits, and then the short-term and medium-term. We basically manage that as a single portfolio, as we showed on the previous slide. So overall assets as of September 30th, it's actually closer to your low point of the year, because in the next few months, November, December in particular, you start to receive your ad valorem revenues, which you've received now for this year. But if we look at the overall book yield, 4.1%. A year ago, that book yield was 4.36%. So we did see the yield come down a bit. That was primarily driven by lower rates in the liquidity funds, but still a healthy book yield versus what we've seen historically. And then if we look, we saw interest rates, as we mentioned earlier, move lower by about 0.75%. Your portfolio yield came down around 25, 26 basis points. So holding on to that, again, laddering out to protect the interest and income availability in the next coming fiscal year or two. And so looking at that on the right-hand side of that center chart, $37.5 million, even though we saw rates come down, your portfolio actually increased in earnings for the year. If we see rates trend lower, we'll likely see that number start to come down just naturally as we're reinvesting at lower yields. But the good news is the balanced approach that you've managed has really helped the city, helped with interest income. And that balance is, as you can see, very balanced, 49% in that 0 to 3 month area on the bottom left-hand chart, and then laddered investments with the other half of your portfolio. It's very balanced at 50-50%, utilizing treasuries for safety, and you're very highly rated, which we're showing on the bottom right-hand side. The last slide I'll cover very quickly before I turn it back over to Ms. Front is your bond proceeds. Your bond proceeds and restricted cash, they're also managed internally by your team. Similar to liquidity, you're using LGIPs, local government investment pools, as well as some banks, but you're also using trustees for these bond proceeds. Those are designated accounts, and then you work closely with the trustees, and those funds are spent as needed through the life of those bond proceeds. With that, I'll pause for any questions for me before I turn it over to Mr. Front.
Commissioner Baduzzi?
Thank you. I'm just looking for kind of a
Yes, sir.
general answer feeling. In terms of our portfolio, where do we stand in comparison with similar sized cities? Are we doing well financially? Does our portfolio look similar? How does it look compared to others?
That's a great question, Commissioner. So we only manage money for public entities. This is a very similar structure. We put a lot of value in this approach where you have half or so. It could vary from 50 to 60%. Not everyone's exactly the same, but to have approximately half or somewhere around there in liquidity, and then have the balance of that invested out, generally between 1 and 5 years, is very common for public funds. Asset allocations may vary by entity between treasuries and high-grade corporate notes, but what you have is a very safe and very similar to other entities of your size.
Follow up, Mayor?
Yes.
What about the value of our portfolio compared to
Sure.
similarly sized cities?
Yeah, when I think about a lot of this is going to be based on your ad valorem revenues as your primary source, and then other tax collections. That's going to determine the size of this portfolio as well as how you spend those funds. So based on the size of this city, I say you're appropriate. Where you have an added benefit is the property values, so that's going to help elevate those ad valorem revenues that you receive. So if you took the size of your city, call it from a population base or a geographic base, you may be higher or lower. You're probably on the higher end because of property values and spending overall. It's general spending overall here in Palm Beach County, but certainly in the city of West Palm Beach, versus another area where it may not be as affluent or property values may not be as high. They would have a lower value. Now, is that helpful for you?
I think so. I think that I'm just looking for just a general feeling as to, our portfolio and where we stand in comparison to other cities. Not that that's completely relevant to what we do here in West Palm, but just looking at it, it looks like our portfolio is pretty healthy.
It's very healthy.
And I'm wondering if it is healthy compared to other cities.
You generally have a very positive trend of balances. Because of the strategy that you have in place for your investments, that's helped your interest income. Your interest income is helping these assets grow as well. And that does provide that level of comfort, if you will, if you do start to see a slowdown in spending, or maybe you see a dip in property values where your collections aren't as high in future years. You've built up a very healthy investment program. And again, with a 4% book yield, which is an earnings rate for you, and a market that's at 3.5% to 3.75%, you're currently earning well above market rates as well. And that will help with income as we look into this and probably next fiscal year.
One final question, Mayor.
Yes.
Are there any municipalities or government entities that have invest or their portfolio is a little more aggressive? Because this is a very conservative investment portfolio, which I think is where we probably need to be. But are there any government entities out there that are going more aggressive and have significantly higher yields? And how do we balance that with making sure that we are guarding the public funds?
Right. Yeah, it's another great question. Other entities may be using corporate notes or a higher allocation in municipal bonds. And so when we're thinking of that, though, we're thinking of A-rated or better, so investment grade or better. Those that are using those may have a slightly higher yield, but as we were mentioning earlier, the yields offered on those securities right now are near historic lows, are very compressed. So if they're investing in that, it's for diversification, not as much as for additional yield. But I would also say it varies. So for the clients that we work with, many of them are very similar to yours, where they favor heavy weighting to treasuries. And in fact, most of our portfolios have a very high weighting to treasuries for the reason of safety. But they may want to have a little more allocation to corporate notes because their risk tolerance may be a little different. But I would say for the city of West Palm Beach, the fact that you're earning over 4% and you're in primarily in U.S. treasuries is a great spot to be in for sure.
Thank you.
Mr. Front, looks like you wanted to jump in, please.
Yes, thank you. No, John actually read my mind on the comparison of the types of investments that we are in compared to our other local government entities that you've seen. A lot of us are sitting in the LGIPs as well as the treasuries because that's very safe, but that's also where we are going to see our greatest return without that risk. And that's what, I implore everybody to remember. We've been spoiled the last couple of years. If you go as short as back to 2022, our interest income was $3.4 million overall. So we're talking 37 million this year. We had 35 million last year and 19 million in 2024. So it's going to start going down, which is why you will see we have started to shift our internal perspective. Over the last year or two, we went very liquid because it made the most sense. We had access to the cash, but it was also our highest interest rates, and it was safe and secure. My first objective is safety by Florida statute. It is not interest income. That's a plus. So when it looks at that and the budget, you continue seeing us budget for low interest income because that is not our goal. And if you build that in, I have to back it out when the rates start coming back down and we can't perform with these numbers. So internally, we have pulled everything earlier into the shorter liquidity stream. Now you see as the rates just started dipping, the 5-year and 4-year became attractive with the treasuries. So now we're dumping money in the later years right now so that our ladder starts to build back out again. And we're gonna be able to hold on to these higher rates 3 or 4 years that are guaranteed in treasuries. They're not gonna come down. Treasuries will come down, but what we secured for this time period will stay and will balance us out as the liquidity and daily rates drop if and when the market continues to come down. So that has been our internal strategy and working with John, how we are essentially hedging our bets against these rates coming down and preparing to hold on to that interest income as long as we can and string this out while first and foremost keeping every dollar safe for the taxpayers.
President Lambert.
Thank you. I'm certainly grateful to have your expertise as well as yours, John, and your team. Could you remind us who serves? Do we have a committee or an internal team who reviews this and helps us decide which funds and how conservative we invest?
So the investment committee is made up of myself, treasury manager, our accounting manager, budget manager, and procurement official. At this point, those are the 5 voting members internally. Per our policy, the decision-making actually lies with me. So they are there in an advisory capacity as well as John. I mean, the number of times that the Johns talk to each other and then come and speak with me. PTMA, they deal with half of the portfolio, call it that, where they are the ones that are making those investment decisions. We had a large local bank, anchor bank, that came in and was trying to talk with us about some investments. We brought that to the committee because we wanted to have a conversation, and the rates ended up being in line and a little bit above what we could get with some other investments. So we chose to invest because they were a qualified public depository. It made sense for the interest, the safety, the security. We chose to invest. But on a day-to-day basis, the investment committee is there as an advisory those decisions rely on me, and I rely on my Treasury manager and John for further input as well.
Excellent. Thank you for that. Mayor, I do have one other question.
Sure.
John, you mentioned the high bond rating and the positive impact that has. I know that we have internal discussions about making sure we do things to keep that bond rating. Can you just briefly talk about the impact that that has on these numbers?
Sure. So again, by design for Florida statute and your investment policy, you have minimum rating requirements. Now, what that generally means is if you're investing in a higher rated bond, you're theoretically going to earn a lower interest rate than a lower rated bond. But the idea again is to be safe. And so the fact that you're in U.S. Treasuries primarily for this portfolio is backed by the U.S. government. The other safety you have is the AAA rating of the local government investment pool. So all of those money market fund strategy investments you utilize, you're diversified between multiple pools, and they're all AAA rated. So that helps. We never want to rely solely on a rating, but they are rated because the rating agencies use certain matrices to give us an idea of how those. We manage one of the pools that you utilize, and I can tell you that we have to follow very restrictive rules to maintain those ratings. All of the pools do, so that provides an added level of safety. And then the banks, which are qualified public depositories, they have to maintain a certain percentage of every dollar that the city deposits at that bank, they put into a statewide pool. All of those I mentioned, what they do is while they may slightly reduce the earnings rate because they're safer, you have that safety in mind, that confidence in there. So that's really what those ratings are driving for you. You're very highly rated. I would tell you, though, in the current market, you're really not giving up a lot of yield, certainly from a historical perspective. So you're earning a very good yield compared to those, and yet you have very highly rated bonds within the portfolio.
Great.
And I hope I answered the first question you had on the previous section about your portfolio. Okay, great.
Thank you.
Thank you.
Commissioner Warren.
Thank you, Mayor. I think that all of the taxpayers can appreciate your subject matter expertise and everything that you bring. I certainly appreciate your prudence. And from what you're stating, it sounds as though we are future ready, that we're anticipating markets and that we're looking at how we safeguard the investments, which is extremely important. And I'm just wondering if there's anything that you've all considered proactively that we should start a conversation about now for additional changes and as things are moving and flowing, and are there any other creative ways that we're looking at how we may need to pivot?
Mr. Farr?
I would say creatively, no.
No.
I mean, so creative is a word that, as in finance, I struggle with. Okay. Proactively, yes, absolutely. John has been internal treasury manager. John has been working every month reviewing the cash flow, looking at where we are at with the capital projects that we budgeted for and plan to spend. Are any of those flowing down that we should be doing something with that cash in the short term? He's also identifying if we have larger sums of money that we can go out longer term. So he is reviewing that cash flow on a monthly basis. He's also meeting with departments. We're talking with them, trying to get bond dollars spent. So we are having more conversations internally, because when the rates are high, we don't have to think as detailed about that cash flow and the timing of how long can we go out. Right now, we're trying to lengthen and secure those dollars for the longer term. That's how we hedge our bets. So we are getting tighter and more communicative with the departments on their needs for funding so that we can match that in finance and then develop the investment plan moving forward.
Well, let me just say, I am, as a CEO of the city, quite pleased and proud of the internal and external team. I think that the quality of expertise that we have in our CFO and in her staff is consistent with the quality of city that I think that we are, and certainly, John, your team, you've been with us for a while. You know It looks like there's good chemistry there. You know who we are, what our preferences are, what our risk appetite is, and I'm sure Ms. Souffrant certainly keeps your toes to the line. But no, I just think it is reflective of the quality of internal talent that we have, and our city is so fortunate to have you in that role, Mr. Front, and the team that you have around, and certainly you, John,
Thank you, sir.
advising us as well. Again, with the emphasis on safety first, but being proactive, anticipating the cash flow needs over time so we can hedge our bets, if you will. Was there any other questions, comments? Okay, Mr. Front. John, thank you so much.
And I'll turn it, just want to say thank you again for the partnership with Ms. Front, her team, and with Mayor and with the Commission. Greatly appreciate it. Get it there. I'm trying to get there. I'm sorry.
Thank you. Okay, so one last side, because I know 37.5 million is a large number, and we get here every year where everybody is excited about this number. And so this is just a breakdown by fund of what we're talking when we say where that interest income is allocated, because it's not freestanding. It's based off of the balances that are held within those funds. So the interest income is then booked to those specific funds. So of this 37.5, 5 million of that is allocated to the general fund. And I know it's in small writing on the bottom of the slide, but I'm saying it loudly, that this interest income does not directly attribute to discretionary fund balance. We are still going through our fiscal 2025 audit. When I have final numbers there and I have that discretionary fund balance, Ms. Johnson will be the first to know, and then we will roll that out to mayor and commissioners. So as excited as we are, it doesn't directly it does not directly mean this is free money. That is not the case.
Commissioner Baduzzi?
So the 37.5 is divided between these funds. Do we do any reinvestment? Do we ever take that interest income and reinvest it? And maybe I just don't understand this because I'm not the greatest with financing or this type of thing. But is there any reinvestment of interest?
Yes, there absolutely is, but even if we reinvest it, we still have to record from the accounting side of the house. We still have to record it as interest income. We can, work with John, and it does get reinvested, but there's still these dollars here are on our books. It is a revenue, and then the cash flow, we may then sweep it, excuse me, talking with my hands, we may sweep it back out to John for further investment. That's where that consistent cash flow analysis that John Rauerbach does also takes into account the interest income that we pull in back into our coffers and turn back around to continue investing. We generally do it in larger sums of money, though. Not, we received a payment of $15,000 from this treasury that matured. We don't do $15,000 at a time. We'll do $5 million at a time, $10 million at a time, and that's taking into account our current dollars within, say, our bank account versus the money that's sitting in cash with John waiting to reinvest. But from a book and accounting standpoint, this is how we record it.
President Lambert?
Thank you. Okay, about the triple asterisk small text at the bottom, I do have a question. So if it is not discretionary fund balance availability assumption, then what would it be? Is it that fees associated with or funds that we have already obligated elsewhere?
So the analysis of getting to the discretionary fund balance and why I am cautioning everybody is because we're still reviewing the fiscal year 2025 budget to what actually came in. We could have budgeted for revenues that didn't come in as we expected in the budget. So that's your revenue shortfalls. This happens to be a revenue where we exceeded the budget, but we may have had other revenues that came in under budget. We also may have had expenditures that came in over budget. So it's the balance where we're analyzing all of our revenues and all of our expenses, and at the end of the year, where did we land? So that extra $5 million here could have been, and I'm saying all of this could have because I don't touch and panic myself until we get deeper into the audit, because that could change on a daily basis. So we just need to get to the end where I have concrete information from the auditors.
Follow up, Mayor.
Yes.
So do we zero budget balance for this type of revenue? Do we?
For interest income?
Yes.
No, we just keep a very low budget. I mean, if my memory serves me, in the general fund, we may have like 250,000 or $500,000 that we budget for income in the general fund, because it's I mean, it was just a couple of years ago where
Right.
that's, the numbers that we were actually struggling to
Right.
bring in the general fund.
That's great. Thank you.
Ms. Johnson, I see your hand.
She covered it, so.
Okay, all right.
You don't want to say it again?
Oh,
Okay.
well, no, I'll wait.
Okay, you could proceed, Mr. Fung.
That was it, sir.
Oh, that's it? Okay.
That was it.
All right, any other questions, comments? Again, job well done, and I
Thank you.
appreciate the update. Our city is in very good hands from a financial standpoint.
Thank you.
Now, Ms. Johnson, you seem like you're chomping at the bit. Do you?
No, I'm not. I'm just sitting up.
Okay, all right, all right.
You know, if I dive into budget now, it's a bit premature.
All right, okay. All right, I don't have anything on the mayor's matters. You guys have anything for the general good of the body? President Lambert?
Thank you so much. I just wanted to say thank you, Mayor, to you and administration, for working quickly, swiftly on getting a month-to-month contract. I did receive the email about the South Olive Tennis Center, so thank you for that. I know that was weighing on the families and the tennis community in the South End. I was just curious because I was only hearing from the South End. Do we have something in place already, whether it's a long-term or a month-to-month at the other tennis facilities?
Yes, as I indicated in the email, the month-to-month that we executed for South Olive is consistent with the month-to-month that we have at Howard. Now, when it comes to Gaines Park does not have a tennis pro, so there is no month-to-month.
Okay.
The intent is to get a tennis pro or whatever the operator that we end up with at the end of the day to also be at Gaines Park as well.
Thank you.
Any other questions or comments? All right, well, this meeting is adjourned. Thank you all. Have a very good week.